My name is Mark Cormack. I'm a Director of Distribution at Pinnacle Investment. We're halfway through August reporting season and we're here with Plato to discuss the Australian equity market and dividend analysis. And today I'm delighted to be joined by Dr. Peter Gardner, a Senior Portfolio Manager at Plato, whose primary responsibility is managing the Plato Australian Shares Income Fund. Look, Pete, thanks for joining me.
Thanks for having me, Mark.
Look, let's kick off with Australia's largest miner, BHP. And like Rio, copper was the standout performer, with iron ore also as a great anchor in the result. What were your thoughts?
Yeah, we thought it was a strong result from BHP as it was from Rio. As you pointed out, it was definitely driven by their strong copper earnings, which now make up 54% of their group earnings. So it was 50% of the last results. It's increasing even further. Their margins are still extreme at 70%, so they're earning 70% on their copper, which is even above their iron ore margins, which are very strong as well at 61%. So the profit was up 30% on last year, which was 4% above expectations. Their dividend was 51% higher than last year, so they pulled the kind of increased payout ratio, and they increased their payout ratio from 50% in the first half to 72% in the second half, which brings their kind of average to around a kind of 65% level. That was 51% higher than last year, which equates to a gross annual yield of 5.6%. So overall, a really strong result from BHP. They continued to take costs out of the business. They're going really well at the moment.
Okay, switching gears. JB Hi-Fi delivered a record full-year result, strong profit, increase in dividends. So why did the market react so negatively to the result, Pete?
Yeah, well, let's start with the positives first. So overall, their sales were up 4.8% last year. Their earnings were up 6%, which was marginally above expectations. They had high sales in all their divisions, particularly New Zealand, where their sales are growing strongly after being weak over the last few years. The dividend was up 21% on last year's ordinary dividend, but if you include the special that they paid last year, it was actually decreased of 38%. So take that what you will. They're now paying kind of higher ordinary dividends, so looking to sustain those more going forward, which I guess is a positive. That equates to a 5.9% annual gross yield on a 75% payout ratio. But as you said, the price was down, and that was because their July sales were actually lower than last year, which is the first time they've reported lower sales for quite a while. And they pointed out two main things. One is that consumer sentiment is pretty low, as we're kind of aware of interest rate increases in Australia. But also their customers are being very tactical about when they shop, and they're generally shopping now during the sale periods and not too much outside of those sale periods. The other thing they've pointed out is that they've had to pass on big increases in prices for their laptops and iPhones due to the increases from their suppliers. And this is a result of kind of huge memory chips going out to data centers and things like that, causing the memory chips for consumer products to have to rise as well. And so that was the negative coming out of JB Hi-Fi results. We'll see how long that continues in terms of the sales coming off, because generally they are pretty good at picking those up again. But yeah, that was the negative.
Okay, energy's been a big topic in 2026. Origin reported last week. It looked like a really mixed result with a flat dividend. How are you positioned here?
Yeah, so we're overweight Origin at the moment. Its profit was 22% lower than last year, and its share price has come back in the last year as well. But this result was actually 5% above expectations because the market had been forecasting an earnings drop. And they particularly, even though their profit was just over 1.1 billion, their strong cash flow was over $2 billion, which allowed them to continue that dividend the same as last year, which equates to a 7.2% annual gross yield. So a very strong dividend payer for Origin. I thought something interesting that I'd share out of the Origin result that they're talking about, because as we all know, the Labor government's put in these subsidies for batteries, and a lot of people have put in batteries in their houses. And what that's actually doing is causing the evening peak periods, which used to be a problem, are now much less of a problem because everyone's using their own batteries. And so they actually Origin don't have to start up their gas peakers as often as they used to, and particularly in summer. And so you can see on the chart on the right-hand side, they broke down the kind of renewables production versus the usage in summer, autumn, winter, and spring. And so you can see in summer, renewables are basically producing all the power that we need. And so with batteries, yeah, we don't necessarily need coal and gas and things like that. But in winter, it's still well below what we need. And so we're not producing anywhere near of what we need in terms of renewables. And so this has actually allowed Origin to turn on their gas peakers for longer in winter and less often in summer, which has meant they're spending less money on maintenance and things like that, which has actually been a positive for their business. So overall, a pretty decent result for Origin in a kind of toughish environment, and their share price responded pretty positively.
Okay, former dividend darling Telstra reported last week. It looked like a weak result, although there was a boost to dividends.
Yeah, so it was a bit of a soft result from Telstra given market expectations. Their profit was up 5% on last year, and their cash earnings were actually up 14%. Now, the cash earnings are higher than their kind of accounting earnings at the moment because they've got really strong cost control, and they're spending less on capex than they're depreciating. So they're building their new networks up for a lower price than they're depreciating them at. So that's a positive sign. And that allowed them to increase their dividends by 10%, which is the same as they paid in the first half. So it was a very similar kind of result to what they did in the first half of the year. And it equates to a 6.0% annual gross yield. So that's positive. The other positive thing coming out of it was that they had a new on-market buyback of $1 billion. So they're buying back more of their shares, which means that earnings per share should increase next year. But the negative was that they actually announced they'd lost 23,000 postpaid mobile subscribers during the year. So that's a bit of a negative. And I think it shows that as the consumer is under pressure, potentially more people are switching out of Telstra to potentially cheaper alternatives. And so that was a slight negative for Telstra in their result.
Thanks, Pete. Look, and as you can see, Plato across the detail when it comes to assessing companies in reporting season across both capital growth and dividend income. And saying that, Plato Australian Shares Income Fund has a dual objective. One is to contribute a much higher income and then also outperform the market on a total return basis. Plato do this by actively investing across the Australian equity market, from resources to supermarkets, banks, telcos, energy stocks and industrials. And to that point, the Plato Australian Shares Income Fund has delivered 9.3% per annum income since inception. It's also outperformed on a total return basis. Now, if you are after any further information, please do not hesitate to contact your Pinnacle distribution representative or visit the Plato website, www.plato.com.au. Thanks for watching and have a great day.
Thanks, everyone.